Hey, this is Marcel with Anvil Wealth. Hi, everybody. This is a very dear friend of mine, Ron Jones. We're here to talk about life insurance and some of the pitfalls that you can avoid to save money and build wealth. Ron's a very dear friend of mine. We've known each other, about a little over 20 years now. And even though I've moved away, we've kept in touch. Thought it'd be a fun video to share with everybody. And Ron was gracious enough to accept my invitation. So welcome, Ron. I'm glad that you're here and good to see your face.
Thanks for the invite.
Always fun to talk to you about insurance. Couple of things. The first thing is the myth of like whole life insurance and that you need it for all your life. And, you really can explain this stuff way better than I. I mean, I believe in term, but tell me a little bit about kind of what you know and what you've seen over the years, because you've been doing this for a long time and you have a lot of experience on this. Share with us some of that.
There's basically three kinds of life insurance out there, Marcel.
Yeah.
There's term. Term's like your car insurance. You get insurance for your car, you crash it, you have a fender bender, they fix your car. Term life insurance, you die, they pay. There's no frills or anything. Well, frills and extra benefits and stuff, you pay for.
Right.
And the reason why they call whole life insurance whole life is you pay for it your whole life.
Right.
The insurance industry has what is known as a mortality table, and mortality tables tells the insurance industry how many people are going to die each year at a certain age.
Right.
And according to the life insurance industry, everybody's dead at age 100.
Right.
So a whole life policy will go all the way out to age 100. Most term policies only go out to age 85, maybe 90 years old.
Mm-hmm.
And term insurance is about 25% to 30% less a year than a whole life policy.
Okay.
But where a lot of people make a mistake is that if I'm paying $985 a year for that whole life policy, and that term policy would cost me $280 a year. This is where this thing called buy term and invest the difference comes up. It's been around for over 100 years.
Right.
It's just that the banks and the insurance industry has purposely withheld the truth from the American public.
That's
how
true.
It works.
Yeah.
So very simply, you pay $280 a year for your term policy, and then you take that other $705 a year and you put it into a savings, like an IRA.
Right.
Or if you qualify for a Roth IRA, because then the money grows tax-free.
Right.
So if you're a 30-year-old male, you have a $100,000 whole life policy. At age 65, you're going to have $32,000 approximately in your cash value account of the whole life policy.
Right.
But what people don't realize, when you die, the insurance company keeps that $32,000 that's supposed to be yours.
Right.
And now the insurance company only has to write a check for $68,000 out of their money.
Right.
Whereas if you would have done buy term and invest the difference, at age 65, your spouse would get the $100,000 death benefit, and they'd get about $280,000 that's in your savings account.
Yeah, it's amazing.
So that's 4 times as much. Now,
amazing.
If you have a car that you never drive,
right,
would you have a car insurance on?
If you never drive it, no.
Yeah, of course not. No, you wouldn't do it.
Right.
Well, at age 65, if you do buy term and invest the difference, now you got $280,000 in your savings.
Mm-hmm.
So now you have almost 3 times as much of the death benefit that the conventional insurance industry people want you to have in a whole life policy, $100,000 policy.
Right.
Well, at age 65, why would you want to continue to pay life insurance premiums?
Right,
because
you have enough.
Self-insured.
Yeah, you have enough cash. You're self-insured now.
You have assets. Now you're like the rich people.
Right.
And then you can just go ahead and let that money cook all by itself.
Yeah.
So if you live to 85 and you don't tap into that money, you're going to have about 1.2 million. Whereas with your $100,000 whole life policy, you're going to have about $75,000 in the cash value account. And those salespeople who represent that kind of product tell you, you can take that $75,000 and cancel a policy and use it in retirement. Well, how far is $75,000?
That ain't going to do anything.
As opposed to 1.2 million.
Yeah, yeah.
So, and then there's another kind of policy, which is known as universal life.
Right.
Universal Life came out in 1977, and quite frankly, it's probably the worst stuff that the life insurance industry ever came out with.
Oh, geez.
What it was an attempt to do buy term and invest the difference, but it didn't work that way.
Okay.
With your whole life policy, you have a death benefit, you have a cash account. They're glued together. One does not live without the other.
Right.
So when you have buy term and invest the difference, you have two separate accounts. Joe's wife gets both of them.
Right.
But with Universal Life, they did use a separate insurance product, which was annual renewable term, which the premium goes up every year as it renews and you get older. And then they got a cash account. But the problem is they're in the same contract. So they still use the cash as part of the death benefit.
Right.
The other problem with that is that when they came out with it, mortgage interest rates, thank you, Jimmy Carter, were 18%. So Joe, average, and the insurance companies, if you deposited $100,000 into a 12-month CD, the banks were paying you a 14% interest rate.
Right.
Well, that's what the insurance companies were doing. And then some of them were even giving the policyholder 8.5% on his cash account.
Right.
Well, Reagan comes into office and he starts to drive interest rates down. So we have a double-edged sword inside that policy because we've got an insurance component where the premium's going up every year. And then we got the savings account where the interest rate's going down.
Yeah, that's not
every
fun.
single that they're paying you. So by the time Bush 41 handed over the reins to Bill Clinton, mortgage interest rates were 4.5%, 5%, and the banks were only paying you 2%.
Right.
Well, the problem is that now that cash account's not growing like the insurance company thought it would, and the premium keeps going up, and the insurance company, here's where the problem was. Here's the Achilles tendon. The insurance company told you, hey, Joe, put $100 a month, every single month, into this policy for your premium.
Right.
Well, maybe when Joe was 30 years old, the cost of the insurance was like $50 a month.
Right.
But every year it went up and up and up. So now, like about 20 years later,
wow,
that premium is now over $100. So now you're paying for the insurance, but no more money's going into the cash account.
Right.
And then what happened is that when you don't put enough money in, the insurance company was able to take what they are short on premium out of your cash account inside that contract.
That's awful.
So this was nightly news by the time the late 90s came around. Literally, millions and millions of those policies imploded.
Yeah. Now, if I don't refresh my memory, are insurance agents that sell life insurance allowed to sell it as an investment?
There have been cases over the years where agents from certain companies actually had gone out and sold whole life policies as retirement plans. And just to capsulize it, the regulators found out about it, the various Department of Insurance from the states, and they went after those insurance companies, and they were fined a whole lot of money, and those agents got in a whole lot of trouble. They were, there was a situation back in the late 90s where an insurance company went into Florida and aggressively solicited women and men of a nurses union down there.
Oh, wow.
And they were told that whole life policy is a retirement plan, and it's not.
Wow.
And so I do some training for people who are getting insurance licenses, securities licenses, and the Department of Insurance out here in California, it's in the law books. You cannot represent that life insurance policy as anything other than a life insurance policy.
So in California, that's a state law. You cannot sell it as an investment. Is that correct?
Correct.
So to any of the viewers, I would say, keep that in mind. If someone's trying to sell you life insurance as an investment, remember that's illegal. They're not allowed to do that.
Yeah. So life insurance is life insurance. It's just simply a death protection. Now, one of the things that has confused people over the years, and let me back up for a minute. Life insurance was term insurance until about the early 1800s. And then the insurance industries got cute and figured out how to manufacture a whole life policy.
Uh-huh.
So over the years and years and years, that's what the majority of the people purchased.
Right.
Was a whole life policy. So everybody thinks it's supposed to be an investment. It's not an investment.
Correct.
Your 401k plan at work is your investment.
Right.
An individual retirement account is an investment.
Right.
This goes into another area, but we'll talk about someday. But an annuity later in life is manufactured by the life insurance industries. It would be a good investment because it gives the retiree guarantees to do with their money, because most people don't know what to do with their 401k money.
Right.
Last. But
exactly.
Life insurance is life insurance, period, paragraph, end of story. That's all it's supposed to be. It's with auto insurance is that nobody is going to finance a car for you when you buy it if you don't have auto insurance.
Right.
And most states, it's a law.
Mm-hmm.
Some states, California, they give you a ticket, you go get insurance, and everything's okay.
Mm-hmm.
Texas, you don't have auto insurance, so they pull you over, they impound your car.
Mm-hmm.
It all depends. So people understand I have to have auto insurance.
Right.
And then renter's insurance or homeowner's insurance, well, nobody's going to rent you anything unless you got a renter's policy.
Right.
Nobody's going to finance your house unless you have homeowner's insurance on there. Well, Mark Twain said years ago, he goes, anybody who dies without life insurance should have to come back and clean up the mess before they go to heaven.
I saw that quote. That's true. That is true.
Yeah.
So. Well, awesome. This has been a great video. Tons of information. I hope that people understand the types of insurance that are out there and how important it is to get a good value term insurance.
If you bought a term policy and you invested some money, by the time you hit retirement age, you're going to be Jake. You're going to be in good situation.
Right.
But if you can't, put that money every month or every year into that savings plan, like a Roth IRA, it's going to grow tax-free.
Right.
But they have a whole life policy because that's just what mom and dad did. That's what grandpa and grandma did,
Exactly.
and the agent, prudential agent, whoever is my buddy. The worst thing that could happen to them at age 65, they would have $32,000 in the cash value account that they never would have had before.
Yeah.
And the way things are going, at $32,000, that might be able to buy you a used car and a cup of coffee.
Yeah, that's about it, if you're lucky. Awesome, Ron.